Hey everyone, welcome back. The economic winds seem constantly shifting, don't they? We hear chatter about inflation sticking around, interest rates doing, well, whatever they're doing this week. And that ever-present question lurking in the background, are we heading for, or already in, an economic slowdown or recession? When uncertainty clouds the economic forecast, investors naturally start asking, where is my money safest? Where can it potentially still grow? It's a critical question. Today, we're going beyond the surface and taking a deep dive into three assets that always come up in this conversation: the ancient allure of gold, the engine of capitalism that is stocks, and the disruptive force of cryptocurrency. Which one truly shines, which one dims, and which one might just explode in either direction when the economy contracts? Just so we're all grounded, remember what a recession generally means: a sustained period, think 6 months or more, where the economy shrinks, businesses produce less, and fortunately, unemployment often rises, and people and companies tighten their belts. It's a natural, albeit painful, part of the economic cycle, and it forces investors to rethink their strategies. Segment 1: Gold, the time-tested fortress. Let's begin with gold. Its reputation as a safe haven asset is literally millennia old. But why does it hold this status? Historical precedent. For centuries, gold was money or directly backed money. It's deeply ingrained in our collective financial psyche as something valuable. When faith in governments or traditional currencies falters, gold often benefits. Tangibility and scarcity. It's a physical element you can hold. It doesn't corrode, it's rare. And while new gold is mined, the global supply increases very slowly compared to fiat money, which can be created digitally with a few keystrokes. Store of value. While often called a store of value, it's worth noting gold doesn't inherently produce anything. Its value comes from collective belief, industrial uses, jewelry demand, and investor sentiment. It's held its purchasing power over very long periods. But it can also stagnate for decades. Inflation hedge. Historically, gold has sometimes performed well during periods of high inflation, as people seek refuge from eroding currency values. However, this relationship isn't always perfect or immediate. So, how does it really act in a recession? Looking back at crises like 2008, gold initially dipped along with everything else in the liquidity crunch, but then significantly outperformed stocks as the crisis unfolded and central banks started printing money. However, in other downturns, its performance has been less stellar. Its price can be influenced by factors like real interest rates. Higher rates make non-yielding gold less attractive, and the strength of the US dollar. Investing options. You don't need a shovel and pan. You can invest via physical gold bars, coins. Pro: direct ownership. Con: storage costs, insurance, lower liquidity, premiums over spot price. Gold ETFs, exchange-traded funds, like GLD or IU. Pro: easy to trade. Liquid. Con: you don't own the physical gold directly. Management fees. Gold mining stocks, investing in companies that mine gold. Pro: potential for leveraged gains if gold prices rise. Con: subject to company risks, management, operational issues, and broader stock market volatility. Sometimes miners fall even when gold prices rise. Pros: long history as perceived safe haven, tangible asset characteristics, potential hedge against inflation, currency devaluation, relatively low correlation to stocks sometimes. Cons: generates no income, dividends, interest, a significant opportunity cost. Storage: insurance costs for physical. Price can still be volatile and doesn't always rise in recessions. Performance: sensitive to real interest rates and investor sentiment. Segment 2: stocks, navigating the storm for long-term gain. Now, let's talk stocks, owning pieces of businesses. The immediate reaction during recessions, often negative. Why the typical downturn? Lower profits. Recessions mean less spending. Businesses sell less. Profits shrink or turn into losses. Stock prices are heavily influenced by future profit expectations. Increased fear and uncertainty. Investors hate uncertainty. Fear of deeper economic trouble, job losses, and bankruptcies leads to selling pressure. Risk aversion climbs. Higher borrowing costs. Often, central banks raise rates before recession to fight inflation, making it more expensive for companies to borrow and invest, further dampening spirits. But here's where the nuance comes in. Not all stocks are created equal, especially in a recession. Defensive stocks, companies providing essential goods and services people need regardless of the economy. Think utilities, electricity, water, consumer staples, food, basic household items. Healthcare, these tend to hold up relatively better. Cyclical stocks, companies whose fortunes are closely tied to the economic cycle. Think airlines, hotels, automakers, luxury goods. These often get hit hardest as spending dries up. Value versus growth, sometimes stable, profitable companies trading at reasonable prices are favored over high-flying tech companies, promising future growth during downturns, though this isn't a hard rule. Company fundamentals matter. A strong balance sheet, low debt, and consistent cash flow become critical. Companies loaded with debt are much riskier in a recession. The opportunity, recessions, historically, have been incredible long-term buying opportunities. If you have a long time horizon, think 5, 10, 20 years. Buying shares of strong companies when they are on sale can significantly boost your portfolios. Future returns. This requires courage and patience. Strategy alert. Dollar cost averaging. Instead of trying to time the bottom, which is nearly impossible, consistently investing a fixed amount of money at regular intervals, e.g., monthly, can be effective. You automatically buy more shares when prices are low and fewer when they are high. It takes emotion out of the equation. Pros: highest potential for long-term wealth creation, historical track record of market recovery and growth. Dividend payments can provide income, especially from defensive stocks. Opportunity to buy quality assets at discounted prices, high liquidity for most stocks. Cons: high potential for significant short to medium-term losses during recessions, requires emotional fortitude to hold or buy during downturns. Dividends can be cut. Recovery can take years. Performance heavily reliant on economic health and company specifics. Segment 3, Crypto, Digital Gold or Digital Risk. And now, the newest and arguably most controversial asset class, cryptocurrency. Bitcoin, Ethereum, and the vast universe of altcoins. Where do they fit in a recessionary picture? The honest answer, even now in early 2025, is that we're still figuring it out. Crypto's history is short, and its behavior during prolonged, traditional recessions is largely untested compared to assets with centuries of data. The digital gold narrative. Bitcoin was initially pitched by some as a digital equivalent to gold. Scarce, limited supply of 21 million Bitcoin, decentralized, and outside the traditional financial system. The idea was it could be a safe haven. The reality, in recent years, particularly during market stress, Bitcoin and major cryptocurrencies have shown a surprisingly high correlation with high-growth tech stocks, like the Nasdaq index. When risk aversion hits the stock market, crypto has often sold off even harder. It has largely behaved like a risk-on asset, not a safe haven. Extreme volatility. This is crypto's defining characteristic. Price swings of 10 to 20% or more in a single day are not uncommon. In a recessionary panic, this volatility could be amplified dramatically. Diverse ecosystem. It's not monolithic. Bitcoin, still viewed by many as the primary store of value candidate within crypto. Ethereum and altcoins often represent bets on new technologies. Platforms like DeFi, NFTs, Web3, their value is often tied to adoption, utility, and innovation. Things that can slow during economic downturns. Stable coins, pegged to fiat currencies, like the US dollar. Some see these as a safer place within crypto during volatility, but they carry their own risks, losing their peg. Regulatory crackdowns. Regulatory and security risks. Governments worldwide are still figuring out how to regulate crypto. Major regulatory decisions, hacks, or platform failures could severely impact prices, and these risks might feel even larger during times of economic stress. Pros: potential for very high returns. Though highly speculative, operates outside traditional banking systems. Potential benefit in specific crises. Fixed supply for some assets like Bitcoin. growing technological innovation. Cons: extreme price volatility, strong correlation with other risk assets observed recently, regulatory uncertainty globally, security risks, hacks, fraud, custody issues. Limited track record during traditional recessions, environmental concerns for some cryptos. Complexity and steep learning curve. Segment 4. Case Study Comparison. How did they perform in the last 3 crises? Let's look at 3 recent events and how each asset held up. Gold held steady or rose. Stocks crashed, then recovered hard. Crypto got crushed but came back like a rocket, and then crashed again. This shows the importance of timing and diversification. Segment 5. The Synthesis. Crafting your recession strategy. Okay, we've dissected gold, stocks, and crypto. So, how do you possibly decide what's better for you during a recession? Let's reiterate and expand on those key personal factors. 1. Risk tolerance. How much potential loss can you emotionally and financially handle? If seeing your portfolio drop 30 to 50% possible with stocks or crypto would cause you to panic sell. You need safer assets like cash, bonds, or perhaps gold in the mix. If you see dips as buying opportunities, you might lean towards stocks. Crypto demands the highest risk tolerance. 2. Time horizon. Are you investing for retirement 30 years away, or a house down payment in 3 years? Recessions are temporary, though they don't feel like it if you have decades. Riding out stock market volatility for higher potential long-term returns makes more sense. If you need the money soon, capital preservation using safer assets is paramount. 3. Financial goals. Are you aiming purely for wealth preservation, growth, income generation? This directs your asset allocation. Gold preserves, stocks grow long-term. Some stocks or bonds provide income. Crypto is speculative growth or loss. 4. Diversification. This is probably the single most important strategy. Don't bet everything on one horse. Spreading investments across different asset classes, stocks, bonds, gold. Maybe a small allocation to crypto if you understand the risks, real estate, cash, and within those classes is crucial. It helps smooth out returns and reduces the risk of any single event devastating your. 5. Investor psychology. Fear and greed drive markets, especially during extremes. Panic selling at the bottom and FOMO buying at the top destroy wealth. Having a plan before the recession hits. Understanding these biases and sticking to your strategy is vital. In a nutshell, potential roles in a recession: gold, potential portfolio stabilizer; inflation, crisis hedge; less correlation to stocks sometimes; no income, stocks, short-term pain for potential long-term gain; opportunity for DC and buying low; focus shifts to quality defensive names; requires patience; crypto, high risk, high volatility play. Mostly correlated with risk assets so far. Role as a true diversifier or safe haven is unproven in -1 traditional recessions. Treat as speculative. So, navigating recessionary waters isn't about finding one magic bullet asset. It's about understanding the characteristics, risks, and potential roles of different investments like gold, stocks, and crypto, and then building a diversified strategy that aligns with your personal financial situation, timeline, and comfort level with risk. The history of markets shows that downturns, while scary, do eventually end. Preparation, a long-term perspective, and avoiding emotional decisions are your best allies. And remember, especially in complex times, consulting with a qualified, independent financial advisor is often a very wise move. What's your take on this? How are you approaching your investments amidst economic uncertainty? Drop your thoughts, questions, and strategies in the comments below. Let's learn from each other. If this deep dive gave you value, please hit that like button. It really helps the channel. Subscribe and ring the bell so you don't miss our future explorations into finance and investing.